Hi, Silver from Bright Broker, and in today's episode, I'm just going to talk about some of the pros and cons of fixed rates versus variable rates. So, first of all, we'll start with variable rates. So, a variable rate obviously can go up or it can go down, dependent on whether the specific lender that you're with chooses to increase their interest rates or keep them the same or move them down. Now, a lot of people believe that the interest rate does have to move, the variable interest rates move with when the Reserve Bank of Australia moves their cash rate, but that's actually not correct. And there have been many examples when lenders have moved completely, independently of the RBA cash rate. So it's all dependent on themselves and their own policy, and they have a special pricing team, every lender will, that decides what they're doing with their interest rates. So first of all, with variable rates, the main kind of advantages would be that you're able to generally make unlimited extra repayments. You have access to those extra repayments generally through something called redraw. So redraw, let's just say your repayment every month is $1,000, but you make a repayment every month of $1,500. So you have a $500 surplus in redraw. So after 2 months, you'd have access to $1,000 in redraw. So you'd be able to take that out from directly from your home loan. Now, every bank will have a slightly different fee possibly or mechanism to enable you to get that redraw. So some banks, they might be able to give you a bank card for it. Some banks might have a fee for every redraw. They may have a minimum of $2,000 or $1,000 that you have to redraw. So there are a few restrictions with redraw. Variable rates, if you have a package option, with most lenders there's a package option which comes with a one-time annual fee, and that will give you an offset account, and in some cases a credit card that's linked to that offset account. So what's an offset account? It's basically like your everyday banking account that you can take money out of. You can pay your bills, pay your groceries. The only difference is it's linked up to your home loan. So let's say you have a $100,000 home loan, just to keep the figures simple, and you had, let's say, $50,000 sitting in your offset account. You'd be only paying interest on $50,000. The reason it's very powerful is interest is calculated daily and it's paid monthly. So exponentially, that will save you a lot of money. So they're the main advantages of a variable rate home loan. Obviously, the thing that we can't really predict is whether the rate goes up or down. So with fixed rate loans, the main thing about them is they provide you with a guaranteed interest rate for a set period of time. One of the ways that I like to look at fixed interest rates is deciding whether you're happy with the current interest rate and happy to pay that for that set period of time, and if it allows you to plan and strategize for what you would like to do in the future, then that might be a good option. But I definitely don't suggest gambling whether your fixed rate is going to remain lower than the variable rate over that period of time, because that's essentially just gambling. So just deciding whether it's feasible and allows you to achieve your goal or strategy that you have in place. So with fixed rates, one of the big differences from variable rates is generally you don't have access to unlimited extra repayments. So each lender will be very different, but some banks, for example, might say you can make $10,000 in extra repayments per year, whereas the next bank might say, you can make $30,000 per year. So it's going to vary lender to lender, and this is where, your broker will be able to explain the differences lender to lender. Some lenders have niche products nowadays where they give you an offset account on a fixed rate, which is really good because it gives you the access to reduce your interest repayments while you're on a set interest rate. So that's a really good product that a lot of people don't really know about or don't see the benefit in. But once you explain it and understand how it works, it's actually quite a really good option. The other thing with fixed rates is if you choose to change your loan, if you're going to sell your property, if you're going to change lenders or basically make any kind of change to the home loan, there'll be what's called a break cost, which can be quite severe. So if you're planning on selling your property or changing lenders, definitely wouldn't suggest a fixed rate, because the fixed rate, the break cost could be $20,000, $30,000. It's all going to depend on how much you've borrowed and how long you have left on your fixed rate. The easy way to look at it is generally the bank is going to say, how much money am I going to lose in interest from this client if they were to leave today, and charge you that, and there might be a buffer on top as well. So with break costs, lenders don't disclose how they calculate them, so it's just not something that you're going to know. So that's a really basic way to look at the difference between fixed and variable rates. If you have any questions, feel free to shoot me an email at selva@brightbroker.com.au or just leave a comment below. Thanks for your time.